Welcome to Subramani. Here is an experiment to make a pretty long video on long-term investing. That is, I'm trying to see what is the role of a long-term investor and what makes a long-term investor. It could be somebody like who can go with a Niranjan Hirandandani and look at a 800-acre piece of land available at a throwaway price and have the vision to see how many buildings can be built, school can be built, whether gymnasium and club and all that can be built to make the place look very great. When I'm talking of places like say a Powai, somebody must have gone to Powai from Niranjan Hirandandani's office and said, okay, this is what we will do, and converted it into a beautiful place to sell flats with lake view, without lake view, with garden view, whatever it is, and made the whole place very great to live, right? I'm not saying it's the best place to live, but somebody had the vision 25 years ago to go and see it. So that is what is a long-term investor. A long-term investor could be an investor in real estate, could be an investor in equity, could be investor anywhere, could be investor even in gold. So long-term investor in my mind is, of course, the person who holds for a long time, but the intent and the latitude. When I say latitude, it means a long-term investor can afford to take short-term fluctuation. The short-term fluctuation does not bother him or her simply because they know that they have to build in short-term volatility. So the long-term investor has a choice of whether to hold it for the long-term or for the short-term. Please understand, therefore, a long-term investor is also a short-term investor at times when he thinks that the value, the price has run far ahead of value. He may sell off, right? So here, if you're building an institution to say, I will do long-term investing, you should have the ability to hold for a long period of time and not get excited by short-term moments. It is not to say that you can't sell in the short term, but largely you go with an attitude that I am going to hold for a long term, right? So I'm going to give you some definitions of what is a long-term investor, but largely an investor who is not bothered about the short-term movement and who has created enough cash flow from some other sources to make sure that he is not interrupted or she is not interrupted in this long-term investment journey, right? So attitude, latitude of investing, so the view that they can hold for a long period of time and not bother about the cash requirement. They've created other sources of cash flow. So the intent is to hold for a long time, and they have latitude to hold for a long time, right? They have the ability to say, okay, if it does badly in the short run, maybe I'll buy more, or at least I have the ability to sit tight because there is no cash flow pressure that I have to meet some margin requirements, I have to sell. No, I have my own cash, it is not a leveraged position, and I know that I can hold for 20, 30, 40 years because wealth is created over decades, not over quarters. So when you are investing for your retirement and you're 35 years of age, you don't have to worry whether next quarter steel will do well or oil will do well. There is no such pressure to say what will do well. You can say, okay, I have a long-term portfolio, I'll pick up good shares which will do well over a long period of time. Could be an FMCG, could be steel, could be oil, could be banking, it doesn't matter. Or it could even be the index. Let's say I want to keep putting money in the index from my age of say 32 till my age of 65 when I retire. So I've got 33 years in which to invest. Why am I saying 65 years of investing even in India? Because the data today seems to be nobody is retiring at 58 or 60. They're finding something to do. Companies are themselves giving extensions or whatever. Sorry, I'm digressing, getting into retirement. No, that's not the intention. So the advantage for the long-term investor is he gets a greater range of opportunities than a short-term investor. Suppose there is a good value that he sees in a particular investment. He need not worry whether the market will recognize that in the given time frame. For example, if let's say Tata Motors is a share in question and the long-term investor buys it, and immediately next week there is some problem with EV or something like that, very likely the Tata Motors will go down. The short-term trader would be under pressure because he has to perform within a particular time frame. Maybe he has borrowed money and for a month, and he has to close the transaction within a month, or maybe if he's a day trader, within the day, and that bad news is going to hit that person. Whereas the long-term investor knows that a dip may be a good opportunity to buy. And I'm just giving Tata Motors as an example. I don't mean it. In fact, I've recently sold it. So to the layman, the difference between a long-term investor and a short-term investor is the long-term investor gets a bigger range of opportunities. He gets a range saying, okay, I think this is a telecom company. It will do well over a 3, 5, 7 year period. So let me invest now. And on the journey, when the numbers come in and it is reiterated that yes, it's a good opportunity, I will add more to it. So I bought this share at 8 rupees or 3 rupees or 5 rupees, and I will keep buying it till the price reaches 30 rupees. It's a validation process, and then I will sell it off at 300 rupees. This choice of range of buying and the range of selling and the period of holding is what distinguishes a long-term investor. A shorter term investor, on the other hand, might say, okay, let me buy this now. I know that's a great opportunity. I bought it at 12 rupees and I'll sell it off at 14 rupees. Every investor has a role. Please understand that there are a lot of short-term investors who provide liquidity, a lot of long-term investors who provide stability. So all of this put together becomes the market. So the latitude, the intent to hold, right, all this is necessary, and very important that a long-term investor has got patience, because short-term fluctuations will happen. The media will keep throwing and saying, oh my God, today it is the stage of EV. So if you have Maruti Suzuki, you're doomed. Or to say, oh, now is the time of green fuel, so you should be shorting Coal India. I'm convinced that these kind of noises you will have to handle. And you will have to tell yourself that yes, Coal India is not a great company, it's not going to run away, but I'm sure I'm going to get 8% dividend yield and a 10% rise in price, which means I'm going to get 18% return. And over a 5-year period, that's a very good return for me to get. So I'm not worried too much about the green talk or about institutions not buying Coal India. To me, in my mind, I have patience. I know price of coal will have to go up because no fresh investments are being made in that. So let me ride the greenflation or the inflation caused by people chasing greener fuels. Let me benefit by that, right? So these kind of choices you get maybe over a 5-year period. Is 5-year long term? I'm not getting into it. I'm saying this is the intent, and I don't have any other pressure. So I can afford to sit on Coal India at 150, 160, 170, 180, saying, okay, I'm getting the dividend and the appreciation, so I'll hold on. These kind of strategy choices are available to a long-term investor. And you could also say, oh, I bought it at 150, I got 10 rupees dividend, the price is 170, I've got a fantastic return, let me get out, let me do something else. That's also possible. So he's a long-term investor. He came with a long-term view, but at some stage he changed his mind about the company, not about the long-term view. He sold, let's say he sold Coal India, bought something else, bought NTPC or something like that, again with a long-term view, but he held it for 5 years, 7 years, 10 years. He held Colgate for 12 years. So all these possibilities are within the same investor, but again the same thing, the patience, the intent, and the ability to sit through volatility. All these things are necessary to make a long-term investor. And long-term investor is more about an attitude rather than just about the long-term holding. So I'm not a great long-term investor because I've held it for 22 years. I am a great long-term. So let us define long-term investing. It's not going to be very easy. Let us look at some of the definitions. So it has to be focused, it has to be research-backed, it has to have the intent of holding for a long period of time. You have to seek getting a positive real return over long periods of time. You also have to not be worried about the short-term valuation fluctuation. You have to have other cash flows which will support this, right? So today, whether it's a Warren Buffett or any investor of that size, they have sitting on a lot of cash saying when the market goes down I can invest. So you could be a contrarian investor, you can be an investor holding a lot of cash during volatile times, you can be an investor who is not worried about your short-term underperformance from a particular range of stocks. If you are an US investor and you have underweighted on FANG or Tesla, obviously your returns will not look as great as somebody who's overweighted there, right? So for example, if you are in the Indian context and you are as of today, which means January 2022, if you are overweight on BFSI, you will be underperforming. If you were lucky enough to be overweight on tech, you could be outperforming, but it does not bother you whether you look bad in the short run. So I keep saying one more definition of a long run investor is a person who wants to look good only in the long run. He is not bothered about how he looks or how she looks in the short run, or worried about underperformance in the short run, or he's not afraid that he'll lose his job or lose funds because of his underperformance. He has to have that attitude, especially if he's a fund manager. He has to have an attitude, I am a long-term investor in, say, a flexi cap or a multi-cap fund, and I know, or even in a multi-asset fund, and I know in the long run I will be able to deliver real returns. Real returns, I mean positive returns after meeting all expenses like fund management charges, risk charge, I would say taxation and inflation. If I can give a positive return, maybe 1% or 2% over a long period of time with my multi-asset attitude, then I'm a long-term wealth creator, right? So that is one very longish definition. Let us look at some of the literature on that. So investing with the expectation of holding an asset for an indefinite period of time. This is very important, indefinite period of time. So if I know that there is a great opportunity coming in the short run, I may take it, or I may say, oh, the market is, I bought the share at 10 rupees, now it is reached 30 rupees, but I will sell the share only when the market realizes its value, and I think the value is 200 rupees. Maybe it take 3 years to find it, or maybe it will take 7 months, like what happened in case of Tata Power. Right, it went from 30 to 260 within a year, right? I could have made short-term capital gain by selling that share. That much I remember. I don't know the exact dates. So a long-term guy logically has a discretion of when to. So very clearly, a long-term guy has all the choices of a short-term investor, but he chooses not to take it. He sees that a share has gone up from 10 rupees to 30 rupees, but he says, oh no, I'm a player who wants to sell from 10 to 210. That's fine. That's a choice that he makes, or from 30 to 240. And at that stage, he says, okay, I think it's a great share, I'll still continue to hold on. So the time period for which he's buying is indefinite. So it could be 3 months, it could be 3 years, or it could be 30 years, saying, okay, I see more value in this share at this price, so I will keep adding. So if he buys at 30, if he buys at 80, if he buys at 90, if he buys at 100, if he buys at 200, and today the price of the share is 842, he's been right at every stage. So he's building position, he's doing position sizing. All these choices are available to the long-term investor. So all the strategies of a short-term investor is available to the long-term investor. He chooses not to use some of them. He uses some of them. Sometimes he may say, okay, I think I've overbought, let me reduce my size. As a percentage, this share has gone up to 10%. I don't want it to go beyond 10%. So he keeps selling at a higher price. Or he says, I've not added enough, let me keep adding. So all these strategies are available to a long-term investor. So he has also created enough cash flow not to worry about he does not have to pay for his mother's operation by selling these shares. For that, he has got medical insurance, and he's got money lying maybe in a ultra short bond fund. So there is no cash flow pressure if he's an individual, and there is no cash flow pressure if he's an institutional investor saying, oh my god, we will have a outflow. He's saying, no, I don't care, I want only those people who have the ability to stay. So to meet the cash flow requirement, I may stay 20% in cash, not only because I have opportunities to buy, but also I have redemption pressure to handle. But if he's a endowment investor, or if he's a provident fund investor who can plan his cash outflows better, he may not hold too much in cash. So these are persons who are less concerned about changes in asset prices over shorter periods of time. It does not bother them over shorter period of time. They're very focused that I want to be investing for the long run, and I want growth, I want long-term capital appreciation, I don't really care much about dividend yields, but I use dividend yields knowing that okay, because there is a dividend yield of 8%, the share will not fall below 150 rupees or 160 rupees, simply because the dividend outflow will ensure the bottom. So the dividend yield, when I look at it, I look at it is the bottom of the share this much. So now I know this much. After that, I see how much it will go up. I will not buy a share just because I know it won't go down. That's not enough. That's a very negative brief. I know it should not go down, so it won't destroy my wealth. But after this, what is the upside? Let us take the same old example of Coal India. Coal India has an EPS of 25 and a PE of 6 at a price of 150, and it pays enough dividend to get you something like 8% dividend yield, right? So if you're getting an 8% dividend yield, you're sure that it cannot fall below this price. So that is fixed. And after that, how much will it grow? Can 25 go to 30? Can PE go from 6 to 8? I don't know whether the PE can go from 6 to 8 with so much coal feeling by the ESG investors and institutional investors. So institutional investors may be under tremendous pressure from a lot of green agencies not to hold. So if big institutional holders don't hold, the chances are the price may not go up too much, the PE may not change. But even if the PE changes just from 6 to 7 and the EPS goes from 25 to 30, you are assured that the price will go to 210, and that's a very good jump, because along with your 8% dividend yield, all you're looking for is a 10% growth. So you're just saying if 150 goes to 165 in a year, you're very well off, because there is going to be 8% dividend yield plus a 10% appreciation. You really are not looking for anything much greater in the long-term investment journey. You may not add, you may add, that's a different thing. So intent for holding for multiple years or multiple decades, which happens largely with people who are managing money for the family rather than people who are managing money for institutions. Institutions have pressure of saying, oh, quarter on quarter you have to perform. People will say, okay, he's a good fund manager over a long period of time, but last 2 years he is not performing. People even go to the extent of saying last 3 quarters he has underperformed the market. That's very bad. But the real the long-term investor is got under no pressure. He's not under reporting pressure. He's not under cash flow pressure. So he's able to handle all that aside. He is able to focus on the long-term thing, and he does not use the short-term solutions which are available, right? So which means he's buying for a infinite period. He's not saying I'm buying it forever. He may even sell it in 3 months if he gets negative information about the quality of management, or he may say, okay, I got 22% return in 3 weeks and that is too much. It's not going to sustain. I will buy the same share if the price comes down, or I will move on to some other value share. It is no longer value, the price has run far ahead of value, so I don't want to buy. So he sells off. Or he holds on for some time and says, okay, I think it's going to do well, so let me hold on for a longer period of time. So the holding period to me in the mind of a long-term investor is infinite, indefinite, or like Warren Buffett says, forever. It does not mean he has to hold it forever, but he has a choice of holding it forever. That's a huge advantage. It's like going to a buffet. It doesn't mean that you're going to eat everything, but you can eat everything. The choice is available. Obviously, you will choose what to eat, right? You will eat sensibly. You will not overeat just because you are in buffet, right? Sorry, I mean you're in buffet. Thank you.